Thomas here from Hoover Financial Advisors with some quick thoughts on yesterday's news from the Fed. The Federal Reserve cut its benchmark interest rate by half a percentage point on Tuesday morning, delivering a booster shot to counter the potential economic disruptions from the spreading coronavirus epidemic. This was the Fed's first between-meeting cut that we've seen since the financial crisis. Tuesday's cut lowered the federal funds rate to a range of 1 to 1.25%. And while Fed Chairman Jerome Powell acknowledges that a rate cut won't reduce infection rates or even fix supply chains, it will support financial conditions and avoid any tightening that that could weigh on economic activity. For the Fed, the spread of the infections has raised the prospect of changes in consumer behaviors that could lead to drops in spending on things like travel or entertainment or tourism. And so while this shock really isn't economic in origin like we saw with the global financial crisis, Fed officials do recognize that there could be still an impact to growth here in the United States, especially if steps to mitigate the spread of the virus, like closing schools or businesses or even canceling events, if that curtails consumption. And so even if the shock is temporary, there are some unknowns on how long things could last. While an interest rate cut won't create a vaccine, it could soften collateral damage and speed up a recovery once things are under control. What does this mean for your portfolio? Well, for bond investors, as rates go down, then the value of the underlying bonds tends to go up. And so in the near term, that can lead to improved bond fund performance. For equity investors, over the long haul, lower rates tend to mean better equity performance as investors are forced into riskier asset classes. The price of equities is bid up, and investors tend to pay higher multiples for equity returns. Despite higher volatility levels and the distortions that are created kind of by these short-term changes in sentiment, we do remain optimistic over the long term for investors in diversified portfolios. For more information, go to our website at hfaplanning.com or reach out to your advisor.